Continuing with topic 4 of paper 12, we now move on to investment management styles. Now, there's a number of management styles, and we can see in the diagram at the top of page 4.12 that these are principally made up of passive and active strategy styles. Now, we've done a fair bit on passive. We're going to look more at active styles now, and we can see that they're split up into fundamental versus quantitative. Under fundamental, we look at value investing, growth investing, income investing. Now, fundamental analysis is basically where we are looking at the characteristics and the opportunities for individual companies and coming up with a view as to whether or not the value they're trading at is above or below their intrinsic value. So we do a fair bit of fundamental analysis, ratios, all sorts of things. Whereas, on the other hand, we have quantitative analysis, and that's not looking at the fundamentals of a particular company. It's looking at trends, historic data, patterns, demand and supply of securities, and where prices are likely to go. It's more a timing strategy than a fundamental strategy. Continuing, looking at the different equity management styles, value versus growth investing. Value investing, you're really looking for companies that are undervalued based on what their potential is. Whereas growth investing, you're looking to investing in companies that have got momentum, that the share price will keep going up, reflecting the growth in the business. Some specific points under value investing, it's based on stocks that are cheap or under value relative to earnings potential. Low price earning stocks are preferred. Well, what we're saying there is the price is low compared to the earnings, based on the concept that markets overreact to bad news, so they may oversell shares in particular companies. And risks are that stock is cheap, not because the market's undervalued, but because price reflects a poor futures earnings stream, and or market may take longer than expected to return to fair value. So there is a risk taking this approach, because you may go for an undervalued stock and sadly it stays undervalued for some time. On the other hand, growth investing, based on stocks that have solid future growth in earnings relative to the stock price. Return comes from growth in earnings, which leads in turn to an increase in the stock price. But risks are that forecast earnings may be unrealistic. Share price may not rise as the PE ratio declines. But we hope that the share price will increase. So there's very distinct difference between value investing and growth investing, and we'll look at the comparison summarized in a moment. Now, the choice of style may be dependent on the stages of the business cycle. Value investors will go in buying if a recession occurs because they see value, assets are undervalued. Growth investors begin buying as the recession ends, when earnings growth is expected. Now, I mentioned the summarization of the differences. Here they are. So portfolio characteristics, and this is often examined. Portfolio characteristics have following attributes: the value investing, lower PE, and therefore higher dividend yield, because they're relatively undervalued, but dividends are still being paid. Whereas with growth stocks, the PE ratios tend to be higher with the dividend yields lower. Now, there's no rhyme nor reason to this, but in the notes, they put forward that value sectors tend to be energy, finance, and capital equipment. So these are the types of businesses that can fall in value as you go into recession. And growth sectors, the ones that will do well as an economy is coming out of recession: consumer goods, technology services, internet, pharmaceutical, and healthcare. Be aware of those, because I have seen questions testing you on the different types of sectors with regard to value or growth. The third, so we've looked at value, we've looked at growth. The third equity style, income investing. So both growth and value investing, they focus on capital appreciation, the share price going up. Whereas income investing, you're looking for a steady dividend income flow generated by stock that is regular intermittent income. Now, as you get older, let's say you're considering retirement, then you're more likely to go towards income investing than capital appreciation, as your investments are going to help you with your living costs. Income stocks tend to be those that exceed average market dividend yield. That's what we're looking for. We're looking for stocks that will pay higher dividends than the average. And classic income stocks include REITs, real estate investment trusts, energy sector stocks, utilities, natural resource stocks, and preferred stocks with high dividend yields. Be aware of those. Now, two distinct styles of fundamental investing, top-down versus bottom-up. With top-down, you're first of all looking at the your asset allocation, equities, bonds, cash, based on macroeconomic factors. Once you've determined the proportions of these categories, you then look at particular industries within the overall economic categories. And once you've focused on industries you like, then you go into those industries looking for attractive stocks. Bottom-up style, on the other hand, you just go straight for stocks. You're looking for undervalued stocks or stocks that are going to grow if it's the growth strategy. And then in doing that, you will have allocated the industry and you're contributing towards the overall asset allocation. And right at the bottom, we're told it's common for active managers to use both methods, top-down approach, complemented with a bottom-up approach for particular stocks. Okay, let's look at other equity management styles. We've been looking at value, growth, and income. Others, a quantitative management style. Now, this is based on numbers, quantitative analysis. And quant fund managers, and often referred to as quants, often build computer-based models using algorithms and rules which can be proprietary, in-house, developed, or based on empirical studies. Now, for quant investing, it can be broken down into three components. First of all, input system, that's gathering data and determining the investment rules. A forecasting engine, generating price forecasts, returns, risk parameters, and then portfolio construction engine, that's then determining the portfolio that you are going to invest in. But it's all driven by numbers. It's not necessarily underlying characteristics of companies. Now, possible strategies used by the quants: behavioral finance, fundamental analysis, technical analysis, proprietary models, and big data analysis. Let's just work through each of these fairly quickly. Under behavioral finance, this style uses analytic empirical results of cognitive and social psychological studies to set investment strategies. So they go out there and they see what the psychologists are coming up with, how people behave, how they make decisions, and that will determine the investment strategy. Investors are known to use mental rule of thumb. Exactly that, rules of thumb, known as heuristics, to make investment decisions. Often they're not involved in detailed analysis. It's sort of gut feel. Now, two investment strategies that come out of these studies, one is momentum strategy and the other is contrarian strategy. Now, you may think you know these, but you've got to be aware of the details, because easy to set questions in this. A momentum strategy assumes that past price trends will continue in the future. Best results tend to be over the short term. So momentum strategies, you see the market moving, right? Let's get in. The best results are over the short term, not a good long-term strategy, because it can reverse. Contrarian strategy, on the other hand, assumes market involves a herd mentality. Well, the momentum can be part of that, with collective crowd action being wrong in the long term. So momentum strategy short term, contrarian strategy longer term. An investment manager would make an investment decision contrary. You go against the crowd, contrary to those in the general public. Asset managers should sell winner stocks and buy loser stocks, but that you are looking at a much longer term. Fundamental analysis. Now, some quants managers use fundamental factors to develop factor models for selecting security and optimizing portfolios. And empirical studies show that small firms tend to outperform large firms. Low P stocks outperform high P stocks. So that's the fundamental factors, some of which they're referring to. Continuing technical analysis, that's the chartists, if you've heard that description. Management style uses technical analysis tools such as charts, volumes, trend lines. You more than just momentum, which is a sort of gut feel. Here, you're trying to analyze how the prices are going to move, irrespective of the characteristics of individual companies. Underlying assumption is that historical returns are repeated in the future, and that stock price, market data, and trading volumes can be used to predict the future price movements. Proprietary models, these are in-house design models. Some quants develop their own proprietary models and trading algorithms using statistical analysis, research, data mining. You may have come across the sort of the classic PhD in mathematics that's employed by a broker and investment bank, and it's in these areas that they encourage them to be productive. Can lead to high-frequency trading, algorithmic trading, which can have severe effects on prices. And then big data analysis. Now, big data analysis, that's becoming more and more popular. Technology-driven quantitative management based on independent trading signals generated from big data combined with artificial intelligence algorithms. So some investors, some brokers have bought up massive databases of decision-making patterns of buyers in the markets, and looking at how their choices change, they can determine where opportunities lie. Some fund managers combine opinions of millions of people, market sentiment, and historical price movements to provide predictions and make investment decisions. You may be aware of some companies that have made a lot of money selling data. It doesn't have to be specific and traced to individuals. It's the aggregation of data that these quant managers are interested in. And then a second area, thematic management style, identifies prevailing themes, social, geographical, demographic, which can impact stock prices. And the thematic funds can focus on things like the greening of the environment, economic, social governance, etc., corporate social responsibility, biotechnology, mobile apps, internet, robot technology. So these are themes that are developing, and some investment managers can follow those themes when they are allocating capital. Okay, that was equity management styles. Now let's look at fixed income management styles, bonds, notes, etc. Different styles: active, passive, and liability driven. And under liability driven, immunization and cash matching, and that's often life insurance considerations. So with fixed income, do you go active or passive? Well, when using fixed income passive management style, the underlying securities are matched to stated performance benchmarks. Similar to equities, portfolio must have the same sensitivity to changes in interest rates. Now that's important. That's different from equity. Yield curve spread and sector spreads as the benchmark portfolio. Returns of a passive portfolio should closely follow the benchmark. That is the same between fixed income and equities. An active portfolio management style seeks to add value by actively adjusting portfolio according to forecasts of, very specific here, interest rates, shape of the yield curve, sector spread, and currencies. So the investment manager, he or she has their eye on these different factors and will react as they change with their allocations across different fixed income securities. Interest rate forecasts will determine how a fixed income manager modifies portfolio duration. Now, this is very important, and there's likely to be a question on this. Please remember, duration price sensitivity of fixed income securities changes in interest rates. Now, if interest rates go up, prices go down, and if interest rates go down, fixed income prices go up. Now, when interest rates are expected to rise, portfolio duration will be reduced to lessen the impact of lower bond prices. Because if fixed income securities have high duration, then the prices will move a lot compared to the changes in interest rates. Whereas if the portfolio duration is low, then the prices won't move by as much when there's an interest rate change. When interest rates are expected to fall, just as I've said, portfolio duration will be increased to benefit from higher bond prices as interest rates fall. So please be aware of those relationships, easy to examine. Yield curve strategy important, as the slope of the yield curve can vary greatly. When the yield curve is expected to move from positive to negative, portfolio manager would be expected to move to long-dated securities because it's likely to go the other way in time. When the yield curve is expected to move from negative to positive, portfolio manager would be expected to move to short-dated securities. So be aware of those relationships. Sector spread strategy focuses on margins offered by different governments, other institutions, fixed income securities. So you're looking at the difference between the interest rates on government bonds and corporate bonds, for example. Portfolio managers also have to consider expected fluctuations in currencies, obviously, when making investment decisions. Securities and currencies that are expected to appreciate will be preferred to those currencies that are expected to depreciate. Yes, it's stated, but I think we're all aware you'd far rather be investing in bonds, in currencies that you expect to appreciate against your own investing currency. And then liability driven, this really is the world of insurance. Choosing a manager for a liability driven fixed income portfolio will be dependent upon the nature of the underlying fund and its investment objective. It can be casualty, accident insurance, or life insurance. And the two that we're going to look at, the first one's probably could be accident, but both of them apply to the world of life insurance. Cash matching aims to construct a bond portfolio so that expected cash outflows can be matched by cash inflows from coupon and principal payments. So you're matching the income from your investments to the outflows. And when you're investing in fixed income, your income is a lot more certain than it is with equities. And then an immunization strategy can also be applied, matching duration of assets and liabilities. So your duration of your assets, that is how they react to changes in interest rates, should be the same as the duration of the liabilities. So irrespective of how interest rates move, your assets and liabilities are matched. In doing so, target rate of return can be achieved regardless of bond prices and interest rate variations. Okay, finishing off, asset allocation management styles. This is looking at strategic asset allocation and tactical asset allocation. Asset allocation is performed using strategic, tactical, or some other form of advanced asset allocation strategy. Once you've allocated to different proportions of assets, be it bonds, equities, the next thing you do is select underlying securities for the asset classes. And the choice of the asset allocation strategy determined by many factors: financial goals, tax concerns, investment horizon, life stage, return expectation, risk tolerance levels. So we're finishing off this section 5, on a much bigger picture. We've been looking at value, growth, income, quants, etc. This is the big picture. This is saying, okay, what's going to determine how much of our capital we're going to put in to these big categories: bonds, equities, cash. And your choices will be driven by the major concerns there: the financial goals of the investors, your clients, their tax concerns, their investment horizon, how long they've got to invest. If it's 25, 30 years, then you're probably more likely to move towards equities than bonds. Life stage, is the person just starting work, or are they about to retire? What is the return expectation of the client, and what is their risk tolerance? All of those very important in determining the asset allocation strategy.